Imagine building an entire neighborhood to serve a community. We're doing just that with one of our multifamily projects. Today, we're sharing the cheat code so you can do it too. But first, how do you put together this build-to-rent development business?
It's all about finding the right dirt.
Do we need to know anything about construction before that?
Well, yes and no. Sure, we've blown through a few drywalls in our days flipping, but nothing to the scope and scale of building an entire community.
In this video, we're going to break down exactly how we built our build-to-rent development business, what the opportunities are, and share key advice on how to get started. Why listen to us? Well, we're not just talking the talk, we're actually doing this. We own over $300 million multifamily portfolio, buying and building this kind of thing. So if you're looking to own or be a part of multifamily or build-to-rent developments, we might know a thing or two about it. So let's dive into build-to-rent, the evolution of real estate. So what is build-to-rent, aka BTR?
So build-to-rent communities comprises either of single-family homes, townhomes, or even apartments. But for specifically townhomes and single-family homes, they're unique because there's no tenant below you or above you. You know those creaky sounds when people run around on top of you. It actually provides greater privacy, accessibility, and convenience. And it also provides that look and feel of home ownership without having to deal with the down payment, mortgage, or property tax. From the investor side, it actually allows investors to invest in income-producing assets from the ground up.
We were in fashion. We had no idea how to do this large-scale development project.
Well, sort of, yes and no. So fashion requires a lot of management and coordination, as you know, between various components that are produced in so many different countries. All of them have to be assembled and distributed. So while the skill sets are not obviously one-to-one conversion, there's a lot of skills that are actually transferable. One of the things that we've done differently since starting real estate is that we leverage experienced partners to help us supplement areas where we're not expert in. And in this way, we can actually scale bigger and faster.
How do we determine which area to buy the dirt?
Simplest answer is based on demand. The more long-winded answer is a lot of market studies and survey that goes into determining the next path of progress, where that will be. Most importantly, ground-up development or sub-market level expertise can't be understated.
So how big is this build-to-rent business today?
What a great question. So I would actually say that BTR is actually the darling of the commercial real estate world today. Everywhere you go, you hear about how great it is. So BTR actually mirrors multifamily apartment boom in 2010. While the trade volume obviously is significantly smaller than the traditional multifamily apartment complex, coming in at only at $2.4 billion versus $311 billion in average trade volume. According to CBRE, the BTR transaction volume has actually increased by 250%.
So why did we decide that build-to-rent development is our next 10x focus? Why not storage, car wash, Airbnb? What make us say yes to this asset class?
Well, we don't know enough about those asset classes to really throw dirt at it. But what we can definitely say is what we saw is the numbers don't lie. BTR versus multifamily, we can see that there's a significant rent gap where significantly high rent bumps are being achieved in BTR based on the data provided by CBRE. BTR also was really resilient during the pandemic. And now we can also see that from the work from home scenario, people are moving towards larger units in less expensive suburban areas or secondary markets.
And in addition, we love to invest where people need shelter to stay in versus like car wash or doing storage, right?
Definitely.
If you think about it, build-to-rent strategy is kind of a brilliant business. Charging a premium, recurring revenue, and remote operations are what make this business model stand out for us. Even though Texas and California aren't neighbors, we made this work remotely. It's a simple, straightforward business with less competition than multifamily apartment investing. And don't worry, we're not leaving multifamily behind. Important tips. When you're building a build-to-rent project, you need to find your who. You don't have to be an expert in every area, but your teammate must be. Trying to do everything yourself can lead to messy mistakes, wasted time, and worst of all, losing your investor hard-earned money. So how long is the typical time frame of BTR development?
Well, we have the pre-development phase or pre-construction phase, which includes purchasing the land, civil plans, and entitlement. So while a lot of developers, they tend to raise funds from the very beginning from this point, which actually lengthens the investment time frame for the investors. We typically elect to actually get this done prior to raising any capital. The benefit to our investor is that it actually de-risks the inherent challenges of new development, i.e. getting the city to approve without actually causing any delays. So this phase typically takes 2 years. Once you get to the horizontal development, that takes about another 12 months. And the vertical, which is actually building out the actual units, that's around another 16 months. The benefit with going with this route is it actually shortens the time frame by almost half because we take about 2 years to do the purchasing, the civil plans, and the getting the entitlement and all the civil plans approval. That part is de-risked for most of our investments. Then you go into the 12 months of horizontal and 16 months of vertical. That part makes it so that the time frame that it goes from dirt to income producing asset for our investor is significantly shorter.
Are you ready for some rapid fire questions?
Bring it on.
How does BTR differ from traditional home building?
Merchant developers, they have a very short investment horizon. They're in and out of deals. While BTR, it's like squeezing all the juice fully from the investment project.
What makes BTR attractive to passive investors?
Maximum value creation. Investing from the dirt means that you take advantage of all the upside that the deal has to offer instead of buying an existing deal.
How do BTR developments generate long-term income?
Stabilized rent from BTR projects are typically more stable than multifamily.
What role does location play in build-to-rent success?
Like any other real estate investment, location is key.
How does BTR impact housing supply?
It actually helps ease the supply and demand imbalance, especially in areas where there's a lot of shortages in the marketplace.
How do we secure financing for a build-to-rent project?
This capital stack involves both debt, aka lender financing, and equity, aka raising money from passive investors.
What are the key demographic trends driving build-to-rent growth?
Population growth.
What's our strategy for leasing out build-to-rent units quickly?
Typically, pre-leasing and other marketing activities happens about 90 days to the first unit coming online, and this is pushed by our third-party property management team.
All right, let's talk about how we de-risk our investment for a credit investor who prefer to keep their hands clean rather than diving into a mega project themselves.
You mean they don't want dirt under their nails?
Yes, so number 1.
Invest in shovel-ready projects fully entitled with civil plans approved.
Number 2.
Our team already owns the land, no land acquisition risks.
Number 3.
General partners are also the general contractors, so don't worry about us skipping out on the job.
Number 4.
Hefty capital reserve. Have at least 10% of the contingency built into any of the budgets.
So, how will we increase income and profits for our investors and ourselves?
This is the beauty of BTR. At every stage of the project's development, we're actually adding value to the project, providing multiple exit optionality should that be deemed necessary and appropriate for our investors.
All right, let's break down some key amenities that a build-to-rent community should include to increase profit.
Oh, okay, so things like smart home features, a pickleball court, EV outlets in the garage, enclosed patio, pet-friendly areas, fitness centers, clubhouse, co-working spaces, obviously high-speed internet connectivity, outdoor amenities, on-site maintenance and management, and of course, parking and storage.
By incorporating these amenities, a build-to-rent community can attract tenants who are willing to pay higher rents, ensuring steady income growth and increased profitability. Let's play a game of pros and cons, why and why not build-to-rent development projects. I will start with dirty cons and you will say pros.
All right.
Con, market sensitivity.
Pro, high demand for rental.
Con, longer development timeline.
Pro, attractive to millennials and young families.
Con, high initial capital investment.
Pro, using other people's money.
Con, regulatory hurdles.
Pro, higher barrier to entry actually reduces competition. As passive investors, you won't have to deal with zoning laws, building permits, and all those things because it's our job.
According to Zillow, the U.S. is short 4.5 million homes as the housing deficit grows, the South having the most drastic supply shortage. In fact, according to the report released by Texas Comptroller Glenn Hager in August 2024, Texas builders didn't keep up as the economy boomed and millions of new residents moved there over the past decade. The lag in home building left the state with a deep housing shortage, with one estimate stating that Texas needs 306,000 more homes than it has. Furthermore, we experienced the largest home affordability gap in the U.S. history. John Breezy, National Director, Multifamily Division at Marcus & Millichap, explained during a recent industry-focused video that for about a 10-year period, the affordability gap nationally averaged between $200 and $300 a month. And now, is above $1,300. You see, the US is rapidly turning into a renter nation, and this type of investment isn't just about becoming wealthy, it's about making a real impact. People area are searching for safe, affordable, and comfortable places to call home. So if you want a piece of this growing market, there's no better time to get started than today.